Hello. Just a quick video on how I traded the S&P this morning. I didn't take a screenshot of when I entered the open, but instead of a Nadex binary, I did a Nadex spread just because the risk going against the trend, I wanted to limit that. So basically I risked 50 instead of 70 or 80. Um, Well, I would have risked less if I would have gone with an out of the money binary, but there weren't any prices I liked. So basically, what we're looking at is this is right here. Actually, right here it's the open. This isn't where I got in. This is where I got in. Is actually over here. So the spread had the floor of 23.35, and then it went up to like 23.85, I believe. Quite a ways up there. The way the spread works is my risk is I pay you put up your premium, and that is your max risk. And the only time you pay out max risk is if you are below that, uh, below the floor. So the max risk on this trade was, I think the premium was 53. So yeah, that was my max risk if price finished below that. My max reward is like 235 or something if it would have ran all the way up to the ceiling. But that's also the cap. That is my cap profit. And I seriously, it's not going to run that far up. Plus, the market's in a downtrend in the most recent highs. So the way I determine that, there's a high, there's a low, lower high, lower low, lower high, lower low. But the reason I went long is because price was below, it was in the buy zone. I don't have the pivots on here, but it was in the pivot buy zone. It had dropped, uh, here, this range right here is the average of the open close, and there's also divergence. So we've got, uh, here's your lows going down, but with the divergence, the lows coming up, that means possible change in, uh, trend, not long term, but maybe just in the immediate. So that's why I went long. My target was just, uh, this line here, 23.40. That's the one that gets me out. If I let it close around 23.40, that gets me out of break even. Um, but just because of the way options work, uh, and delta, gamma, all that stuff, price was a little bit higher at that point. So at the time, I think that was like $7 or $8 per contract profit, and then shooting up to here is where I got out. I ended up I don't know, ended up being 30 profit is what I ended up getting per contract on this. So once I reached that point, I was looking for the exit, and it just shot straight up to this, which was where I was looking to get out, uh, no matter what. Because at that point, because we're in a downtrend, that would be the possible pullback for the reversal to head back down. So that's how I traded the open on the downtrend. Prices were showing possible reverses, but they were, I the idea is price is down here in the buy zone area, not up here in the sell zone area. So I had an opportunity to get in, so I took it. I was looking for really careful watching price to make sure that if it would have turned around up here, I would have been getting out really quick. As long as price finished above this, or got out above this 23.35, I mean, I was only risking like what, $5, $10, and even if price would have been below this, I still would have only been risking maybe 10 because it's a close at expiration that I would have been out max risk. So I have all that amount of time to get this amount of profit. So I'm risking very little to gain. So I was probably only risking 15 at the most, and I ended up pocketing 30 per contract. Now on the flip side, when the thing I watch for is average trading range. So for the last 20 days, high to low, this thing has been averaging about 20 points. And so when it had reached here, it had already put in about 12. And that, so I measure the high. So one of the things I measure is the average between the high and the low. That's that 20. I measure the open to close, which is only right around 7. And then I take the average of those two, which is 13 and a half. So we'd already come up pretty close to that 13 and a half. So that 13 and a half is where that range normally gets filled 80% of the time. The open to close gets filled probably 90 to 95% of the time. And that high to low range only gets filled maybe 68% of the time, if that. And so since we're in a downtrend, I'm pretty confident we weren't going to run that full 20 points up. But even if it did run up 20 points, one of the things to note is that high to low range is 20 points, but the difference between the open and close is only 7. So that means you have massive amount. We've got big ranges on the extreme, but we've got also pretty substantial retraces. So even though we've got these 20-point swings on average, open and close is only 7%, or it's only 7 points. So that means price is running up and dropping back down substantially, or running down and running back up substantially. So with that in mind, with price being here, hovering around the average of those averages, I did an in the money binary. So my strike up here is 23.50, meaning all I need to do is have price close one tick below that, and my binary catches me out. So I'm risking $80 a contract to get $20 in profit, which is that's a pretty hefty risk per little amount of reward. However, I have statistical, I don't know, I don't want to use the word safety, but I have statistical probability on my side. So we're in a downtrend, and so I'm going with the trend. I have statistical probability in the fact that we've already ran up the average of the average, right? So even if price ran, I'll just the max at high to low, so that would have, so from here to here is about 20 ticks. So I would need price to close above that, right? So even if we ran up that 20 ticks, what else do we do? We know that there's massive retrace. So even if price comes up here and I'm sitting at max risk, $80 in the hole, the stats are on our side that it's going to retrace and finish probably around here on average. I mean, that's not guaranteed, but that's that statistical safety. And so the other thing I have when I went into shorting this also is, again, this oscillator. So when I got in, we were making, so here you have lower lows. The oscillator was making higher lows. That's one of the reasons I got in. But then the oscillator also is, price ran up to this trend line on the oscillator. And so I'm thinking, okay, even if it does come up above this, chances are it's going to, the oscillator is kind of showing that it's kind of trending down. So I kind of expect this to come down off this trend line on the oscillator. So I've got quite a few things in my favor. So that's why I went ahead and put on that in the money binary at the 80-20 risk reward. And then I've also got my eye on this thing, and I'll look for other opportunities to either, if it comes back down, I might look to get in a long in the money. And what that does is that would be a butterfly, and so that's a way to hedge at it, to hedge some risk, but also add a little more profit potential. Or what I can do is set a out of the money binary, like maybe down here, and so if price comes and touches that, I would just catch that out, and that would that amount would count against the risk plus what I already made on that first long to count against the risk. So right now, as it stands, if I finish a loser, so I 130, I would lose 50 overall. That risk is a 1-to-1 risk day, and I'm cool with that. So I'm risking 50 to win 50, and that's with my win percentage. I finish ahead of the game over time. I wouldn't. I can live with that. If I win, I'm winning. I'm winning 50 on the day for that same amount of risk, but I've got probability on my side, so I'm happy going with that 1-to-1 risk, just based off of my win percentage, and my win percentage is based off of just doing the same setup. So that's just a quick video on how I traded the open and how I'm looking to trade the close, meaning I just need to be one tick below this 23.50, and I'm actually leaving for the day, so this is pretty much a set and forget trade. So I've either won 50 on the day or I've lost 50 on the day, so we'll see how it plays out.